Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what has been driving investment markets and what to look out for in the days and weeks ahead. Now, since the last show, things have got really interesting in markets. So stocks have rallied, particularly in the US. So we've been driven by FOMO, the fear of missing out, and rotations, with the latter powering the former. So if we go back a couple of weeks and look at what actually happened. If you recall what happened, the Fed, the US Federal Reserve, cut interest rates, and we've already had this extra round of QE announced. But we also had the US and China start to reach out to each other to try and form a trade deal. We're still waiting to see what that is, called phase one. But at the moment, it looks like we are making some headway at least. But Trump being Trump, yesterday poured some sort of cold water onto that. But last time I asked the question about would Apple drive the stock market higher. If you recall the adage, as goes Apple, so goes the stock market, which basically hints that if Apple, which makes up a large portion of the S&P 500, if Apple stock price starts to rally, then it starts to push the general stock market higher. Now, last time, Apple announced some good results and their stock has started to pick up in value. And if we fast forward now a couple of weeks, it seems that that did actually start to give some momentum to the wider stock market. So we now have the S&P 500 hitting all-time highs. We've in fact had a number of all-time highs in the last week or so. Now the S&P 500 broke above the 3,100 level, which it had never done before. In the UK, we saw the FTSE 100 rally above that critical 7,350 level, so it pushed on up towards and above 7,400. We've pulled back ever so slightly right now, but we still got this sort of bullish momentum in the stock market. Conversely, if you look at bonds, if we take the 10-year US Treasury yield, that was about 1.7 the last time I made this show, but it's now pushed up towards 1.9. Some people are asking the question, could we go above 2%? It's possible, but we're seeing these rotations that I mentioned earlier. In particular, we're seeing a rotation out of bonds into stocks, and that's partly because people are now pricing out the possibility of a recession imminently. So we're now starting to think that the global economy, particularly in the US, may actually be able to start to show some form of recovery. Whether that is pure hope, we've yet to see, but the economic numbers that have been coming out haven't perhaps been as dire, but they're still pretty poor. If you look at the profits from corporates from this year to last year, they are actually falling. So it's not all good news. The fundamentals still aren't rosy, but investors have been gripped by this FOMO, thinking that they're going to miss out into the end of the year. And don't forget, there is a seasonal pattern of strong returns in stocks between the start of November and the end of April, and that's called that sort of winter period. They call it the winter portfolios I talked about for 80/20 investor members, and in particular the funds that benefit from that phenomenon. So go check it out. You can take out a free trial, a free 30-day trial I should say. But we're in a positive period generally for stocks. Will we see this Santa rally into the end of the year? What's happening is fund managers are starting to panic. They need to make some good end of year results. So that's starting to add fuel to the fire. Is it all just complacency and will it come crashing back down? We've yet to see it. Of course, that means the VIX, the fear index, has fallen. So we've gone down towards the level of 12. So the fear is coming out of the market. Now the bets on the VIX falling, so bets that the fear level in the market will keep tumbling, are increasing. Now that is a sign of complacency in itself, and there is always that chance that we could reverse. If we do, it could be quite violent. But at the moment, everything is awesome if you look at stock markets. Now, I just want to point out some of those changes, those rotations we've seen. If you go back to September, we started to see a rotation out of growth stocks into the value stocks, the unloved stocks, the ones that had underperformed most of this year. And we saw investors rush from the former into the latter, which caught a lot of people off guard. We also have seen a pattern for defensive stocks to start to underperform. Now, in recent videos, I've talked a lot about REITs, real estate investment trusts that have done particularly well in America, utilities, so defensive sectors that have held up well every time we've had increased anxiety over the trade deal or fear that the global economy might actually start to slow. But now that everybody seems to be betting on the fact that we're going to get a trade deal, the Fed has the back of the US economy and obviously the stock market, it means that defensives are started to lag, and cyclical stocks, those things that are most exposed to the economy, are starting to rally. And we're now looking to see if that's going to be sustained, because in the last few weeks that has accelerated. We've seen that happen faster and faster alongside bonds selling off. So those of you who've got slightly defensive portfolios may be wondering why your portfolios are falling in value while the rest of the market is actually rallying, and that is why. And of course, at the same time, we've had the pound continue to rally. We had some news around Nigel Farage saying he wasn't going to contest certain seats where the Conservatives are going to be contesting in the general election. That was seen as positive for the pound. So you've got this perfect storm for defensive UK investors where their portfolios have lagged in October and into the start of November. So we want to see how that pattern plays out. The other trends we're seeing, these other rotations, are from large caps to small caps. And obviously for UK investors, that's partly because of the currency. When the pound rallies, the FTSE 100 tends to fall. Of course, if they're also thinking that the UK economy is going to pick up, then domestic UK stocks are where they would want to be, and that's why they've been bid up of late. These rotations are the lifeblood of a bull market in stocks. So we do want to see them, but of course we do want to try and understand why they occur. Is it just because of a fear of missing out? In that case, you could just be getting a final melt up in stock markets before an eventual collapse once the fundamentals catch up. Or are we seeing a change in fundamentals actually happening and the market is slightly forerunning that? So for example, is the global growth or the outlook for global growth improving? I mean, there are early signs that people are starting to buy back into European banks, for example. Is that a sign that there is some strength in the Eurozone? So the German economy, for example, looks like it could be bottoming. So the falls in its economy have started to slow, and we could start to see that pick up. Another interesting thing to keep an eye on is currency, but not the pound this time, but the dollar. So the dollar has shown signs of weakening. It's at a critical level. If you're an 80/20 investor member, I've talked about the key level on the US dollar index to keep an eye on. If the dollar falls and continues to fall from here, it will start to dictate which assets will start to outperform in the coming months. And keep a particular eye on commodities if the dollar does keep falling against that basket of global currencies. So the other thing is, the negative we've seen out there is breadth is still not improving as we'd quite like to see. So there's still all to play for. But if you look just at the indices, the stock market indices, you'd think that everything is awesome, particularly in America. There is still some lagging in the wider market globally, but we'll keep an eye on that. So that is it for this week on Damien's Midweek Markets. Those of you who subscribe to my 80/20 investor service will have seen that I changed my portfolio this week, which takes in a lot of what I've talked about in this video. So if you want to have a look at that, then do subscribe to 80/20 Investor. You can find out more on the website. If you want to get in touch with me, you can via email, damien@moneytothemasses.com, or via Twitter, moneytothemasses with a number 2, Instagram of course, and don't forget our Facebook community. And finally, don't forget to subscribe to our YouTube channel. So until next time.